guys, what's up? In today's video, we are learning ledger, debit credit, and journal entries. First of all, we are going to have some explanation that what these things are and what is their format. And then we will look at an example exercise which will hopefully allow you to understand the concepts more and know how to solve questions regarding these topics. But before that, I do want to tell you that I have notes available for these topics. There is some explanation and there are lots of exercises that you guys are going to love. There is additional example exercise as well as some other questions which will give you a pretty good idea of these topics. And without further ado, let's get started. First thing is debit credit in accounting. What is debit and what is credit? Let me give you a very simple concept. First thing, you should remember that these represent increase and decrease in your accounts. Another thing, please concentrate on this topic because this is one of the most crucial and basic thing in accounting. If you understand this topic properly, you can say that you have understood 50% or even more of accounting. These two represent increase and decrease. Sometimes it can be very confusing to understand it. Hence, we are going to compare these with destination versus source. Debit is your destination, which means where do you want to go? What do you want to do? What exactly is it that you want to achieve? And credit is your source. How of all those things is your credit? Let me give you an example. Let's say you bought a pen for 10 rupees. Alright, pen was your destination. You wanted it. You wanted to achieve it. How did you achieve it? You paid 10 rupees for it. Alright, you gave money and you got your pen. So pen is debit and your money is your credit. You gave that up to achieve the pen. So what you achieve is your debit. What you give up is your credit. This is another way to remember it, but destination and source is much more clearer. Let's say you bought furniture on account. Furniture is your destination. You wanted it. You wanted to achieve it. So furniture is debit. And you bought it on account. Account is accounts payable. A debt. That debt is your source. So that's your credit. Let me give you another example. Now, continuing the same example, when you pay for this debt, this payable, what will happen? So you paid an amount for furniture payable that you just bought in the previous transaction. What were you trying to achieve? You wanted to be debt free. You didn't want to have a liability. So what's your debit? Your debit is furniture payable because you are achieving that. And then how did you pay for it? You paid cash for it. You paid your money for it. So that's your source. And what's our source? Our source is our credit. And that's how you will identify debit and credit in your transactions. Debit is on left hand side, whereas credit is on right hand side. Now next topic is journal entry. A journal entry is a record of the business transactions in the accounting books of a business. It is a very rough, you could say, record. Yes, it has a format, but you don't really consider anything else. You write your transactions in chronological order. As in, I bought this, let's write it. I did that, let's write it. You write as it happens. You don't wait, you don't think about should I write cash first? Should I write cash only over here? Should I write payables only? Should I write what I bought? No, you just write whatever happens in your accounting. Now how do we write a journal entry? As I said, there is a format and you have to learn it. There are 5 very simple things. Date, account name, Over here you write the names of the accounts which are affected by your transaction. And if you don't get it right now, don't worry, we are going to do example exercises and you will get everything. You will understand everything in those exercises. Right now, just be patient and understand what I'm trying to say. However, if there is confusion, don't worry, just wait till end and do get notes. They will help you. So, account name. The account which is debited and the account which is credited. You are going to write both of them over here. If you remember, we said that every transaction is impacting two accounts. It has double effect. So we write double entries. If you haven't watched previous videos in which we talked about it, you should. They will give you a very good base of accounting. And then we write the debit amount and credit amount which will be equal. And then we write description of the journal entry. Exactly what happened. So we talked about purchasing a pen. Today is 9 November. So we will add date 9 November. Then our debited account, as we said, what's the destination? We bought a pen. So that's our debited account. So we will write pen. How much? 10 rupees. So we'll write amount in the debit column. Then on credit account we'll write cash, that was our source. And on credit side we will write 10 again. And description of the journal entry, we will just write simply bought a pen. That's it. We don't have to go in length for description. It's just a simple idea, simple line, a few words that allows other people to understand exactly what this journal entry is about. See, if someone sees pen cash and a pen was bought, there is no confusion. You instantly know, okay, so this person bought a pen. It was for 10 rupees and they gave cash for it. Understood? And when did it happen? It happened on 9th November. So that's your journal entry. And now in the upcoming examples, we will be doing those as well as ledger accounts. Now we will move forward to ledger accounts, or as we call them, T accounts, and it is also known as double entry. Alright, so ledger accounts. First, let's look at what's double entry. What do you mean by double entry? Every transaction affects two items. We have established that. Whenever you achieve something, whenever you get something, your destination, there will always be a source for it. Hence, two accounts will be affected. There will be two items. Double entry is done to show change in both the items. Exactly what you are giving up to get the other thing. This is the bookkeeping stage. Ledger, journal entry, all these things are bookkeeping stage. Once we are done with those, then we will move forward to statements. And financial statements include what? Balance sheet, income statement, and so and so. These are also known as double entry bookkeeping. These are just some extra fancy words, but you have to know it so that whenever you see something like that, you know what exactly are we talking about. The accounts for double entry, ledger accounts or T accounts. Here is the format of a ledger account. Title of account written here. Title of any account is written here. You will write cash, capital, payables, and so and so. Okay, here's the thing. Why these are called T accounts? Because these accounts are shaped like T. Now on the left hand side, you will write whatever is debited. On the right hand side, you will write whatever is credited. You make one T account for each account. And then you will keep writing stuff in it. Whether it has been debited, whether it has been credited, all the transactions will be written in them. Each account has a different T account. Let's say cash is going to have its own account. And throughout the month, whatever transaction occurs, you are going to write all of those in that exact one T account. You don't create various accounts for T accounts. There's just one and you are going to fill it, and fill it. And then at the end, you are going to write balance. And as I said, don't be overwhelmed. If it is a lot, just relax. Once we start doing exercises, you will understand it. I promise you. Now this is some sort of small hack sort of given that capital accounts, any asset account, any liability account. But you don't have to remember it. You will understand it once we start doing sums. Alright, as we talked about destination and source. So these are your ledger accounts. Now this is a process through which you record your transaction into the journal. Identify transactions. Once a transaction is given, it's very important for you to understand it and to identify it. Specify accounts affected by the transaction. You have to specify, you have to write what accounts are being affected by this transaction. Let's continue that pen example. I said you bought a pen for 10 rupees. Now you know what's happening there. You are buying a pen for 10 rupees. Alright, that's your identify transactions. Now specify accounts. You know, we bought a pen. Okay, pen is one account and we paid cash for it. Cash is the other account. Next comes determine whether each amount is increased or decreased. That is debit or credit. We have already understood it. Pen is our debit and cash is our credit. And then last step is to enter transaction in the journal or ledger. Now this is the last step. Once you have identified and specified and determined, now you are going to enter your transaction in the journal or ledger within the format that I just told you. Now we are done with the theory part. I hope you guys understood it better. Don't worry, everything is written in my notes. Do check them. You'll have a lot of content over there. Now we are opting for our example exercise. So get ready guys. Now we are going to do some exercises and you will understand everything easily. Alright guys, now we are doing our example exercise. So first transaction is the owner starts the business with 10,000 in cash. As we said, we have to understand the transaction first. Over here, it's pretty simple. The owner invested 10,000 cash in business. Now, what accounts are being affected by this transaction? We are getting more cash and we are getting more capital. If you have watched any of my previous videos, you would know that owner's amount is called capital. Those videos will be linked in the description box. You can check it. So cash and capital. Now we have to see which one is debit, which one is credit. Easy, simple. What is our destination? What does business gain? Business gained cash. And what was the source of that cash? The source was capital. So capital. So cash, debit, capital, credit. Now we have to write the explanation of the transaction. You can write anything over here. It's perfectly fine as long as you are delivering what exactly is happening. Received initial investment from owner. Owner invested in business. This could also be written. Or you can say money was invested in business by owner. You don't have to worry about description. You can write anything over here as long as it conveys the meaning of the transaction, as in it gives the picture of the transaction, what is happening. Now we are going to create ledger accounts for these transactions. There are two accounts used, cash, capital. So we are going to create two ledger accounts. We have seen the format. First, let's go for cash. From where is this cash coming? Capital. So date, capital and amount. How much cash do we have in total? There's only one transaction and one amount, so the balance is 10,000. Balance is usually what's remaining. Right now it can be a bit confusing, but soon you would know why exactly do we use balance over here. Next transaction is capital. Alright, why do we write cash and capital over here? In the description, this is a way of connecting two T accounts. Whenever you are confused and you think, okay, so there were 10,000 cash If capital wasn't written here, you won't know from where this cash arrived. You'd be like, is it revenue? Is it we sold something? What exactly happened? How did we receive 10,000? But since you wrote capital, you know what's happening. 10,000 came through capital. Now in capital, you are going to write cash. And we have already identified which one is debit, credit in our journal entry, so we don't have to go through that process again. But unless you haven't decided and maybe you didn't make the journal entries for this transaction, then you should. Because otherwise making a direct ledger can be tricky and tough. So do make journal entries even if the question is not asking you to make it. It's for you, it's for your ease. Next transaction is a van is bought for 4,500 cash on 2nd August. Van is bought. Van is our destination. The business purchased a van for 4,500 cash. Van is your destination and the source is cash. So journal entry van debit, cash credit. Now description, bought a van for cash. Or you can say purchased a van for cash. Gave cash for buying a van. You can write anything in the description. The main thing over here is to identify the accounts and debit and credit. Which account is being debited and which account is being credited. Now we are going to make ledger accounts. Now van is very simple. You don't have to do anything. You just have to write van 4,500. What did you give up for it? Cash and date. And then you are going to write balance and you will just write the exact amount. But when it comes to cash, remember I told you that you are going to follow only one T account. And usually when it used to be done on journals, there used to be one page for each T account. So in this one, we are going to add our cash. We have already created a T account for cash. First transaction was capital, if you remember. And now second is 4,500, which is for van. But the problem is that one was what? Yes, debit. This one is credit. That one was increasing. This one is decreasing. You are paying 4,500 from 10,000. Now when you are going to write balance, you are not just going to copy paste these amounts. Instead, you are going to subtract them and see what is the balance of cash. 5,500 is remaining. We had capital 10,000. We bought a van for 4,500. Alright. And then when you gave 4,500 from 10,000, as in 10,000 minus 4,500, 5,500 is remaining. Understood? If you understand it, make sure to give this video a thumbs up. Now we are going for third entry. Fixtures are bought on credit from shop fitters for 1250 on 3rd August. Fixtures were bought on credit. What is credit? Credit is basically liability. You said, hey, I'll pay you later. Come on, you can trust me. I'm your old fella. So, fixtures, alright? Fixtures is what we got. This is our destination. This is what we wanted as a business. And what did we give up for this? What was the source? That is our credit. Now, this situation, when there is credit and we have to pay someone else, we will write shop fitters payable. You could write only accounts payable, but that's not okay. Because what if you had a lot of payable accounts? Let's say you wrote accounts payable over here and then you took something from someone else on credit and you wrote accounts payable over there. How would you know how much you owe each of the individual? You cannot do that. That is why you have to write that whose account payable is it. Same goes for receivables. Do know who is owing you how much and whom are you owing and how much. Do know your debts. So fixtures is our debit. It's our destination. Source was shop fitters payable. Both are at 1250. And now we wrote explanation, which is bought fixtures on account. On account means liability. On credit, on account, as in you promised, hey, I'll pay you later. We have discussed it in the accounting equation video, so you can check it in the description box, as well as we discussed it, I think, in accounting terms video. So I'm not going to go in detail for these topics. However, if you are interested, all the videos will be linked in the description box. Now we are going to make ledger accounts. Alright, so there are two things. Super simple, super easy. We have done this. You should know it by now. Fixtures, date, shop fitters payable. You are connecting the ledger accounts, and then 1250 and balances, of course, 1250. Same goes for shop fitters payable. And here are your ledger accounts for this transaction. Now the upcoming transaction is a bit tricky. Paid the amount owing to shop fitters in cash on 17 August. Remember, you got a debt. Now you have paid it. How much debt was it? 1250. And since it's not written here, like if it was written we paid 500, then you would know, okay, so they only paid 500 from 1250. However, it's just saying, hey, we paid the amount we were owing to shop fitters, which means they closed their account. They paid them whatever they were owing them. So over here, what is our destination? We want to be debt free. We don't want our liability anymore. We want to pay our liabilities. That is our destination. So shop fitters payable is our debit. What is our source? Cash. Cash is our source. So cash is our credit. Then we wrote a description, paid for fixtures bought on account. In explanation, we have linked this to the previous transaction. We just said paid for fixtures. Alright, why are we paying shop fitters? Why were we owing shop fitters in the first place? Because we bought fixtures. Easy peasy lemon squeezy. Next is we are going to do ledger accounts for these transactions. Shop fitters payable. We already created one ledger for it. We are continuing that one. Now this one is actually debit. Previous one was credit. So we are going to write 17 August cash 1250. Alright. So in balance you are going to subtract them. And once you subtract them, it's 0. So we don't owe anything to shop fitters anymore. The account is closed. We paid the amount. Alright? Understood? There is no balance. It's 0. Now we are going to look at cash. The T account for cash. Alright, now we have like 3 transactions for cash. First one, capital, which was in debit. Then van, which was in credit. And then shop fitters payable, which is our current transaction. So we have already established that capital and van would be subtracted. Now shop fitters payable. We are paying them money, 1250. We have to subtract it as well. If in case we were earning some revenue over here, that would have arrived on debit and we would have added that amount. However, that's not the case over here. We are actually spending money. So we are going to subtract it and our balance is 4,250. And then what you do, you just write transactions to date. What's remaining? What's the balance of each account? Cash, capital, van, fixtures. And if you are thinking, what happened to shop fitters payable? We have already discussed that account is closed. Alright guys, so that's pretty much it for this video. I really hope you guys enjoyed it. Don't forget, there are notes given in the description box. Make sure to check it and I will see you guys in my next video. Bye guys!